So most traders lose money because now there's so much information online and it's very scattered. In this video, guys, I will give you absolutely everything you would need to know about trading, and I will share many years of experience with you. So I'll get to the point straight away. Really, there's two major components to trading: discipline and position size. And of course, they're connected to each other, but the reason you need to have discipline is because even if you're determining your position size, you need to be able to stick with it. In my case, I cannot dedicate more than 2.5% of my trading portfolio, not overall portfolio, towards a single trade. So let's say I have many indicators that sort of tell me that the trade is likely to go into the direction where I want it to go. In that case, I can allocate 2.5%. If there are a few indicators, but not too many, I can dedicate 1.5%. And then if I'm speculating, and of course we're speculating all the time when we're trading, but if it's very speculative, then I can dedicate 0.5% of my trading portfolio into that trade. And with discipline, also when it gets to indicators, you need to be able to follow them all the time. Because if you make one mistake, so let's say for some reason you decided to dedicate 10% of your trading portfolio into a certain trade, maybe it's Bitcoin, you can see that it's likely we were going to have a bull run, etc. Well, if you do that, and if something unexpected happens, which can always happen, by doing that, you can erase your gains for many, many months ahead by just making one sort of bad decision. So really, really important to have your own set of rules and follow them all the time. Then when it comes to indicators, of course, I will not have time in this video to talk about all indicators, but let's say you have a cup and handle with gold. So with gold, you had the large cup and handle formation, which is great. But usually it's wise to combine a lot of indicators. So you could look at volume, you could look at RSI. In my case, I like to combine trading and a little bit of fundamentals as well. I know people who just focus on pure charts and they do really, really well, and that's completely fine. So that's one approach. The other approach is what I do is combining fundamentals and technicals, because I believe it gives you an extra edge. Because I had a situation where one of my friends, he's a trader, so he was telling me about this trade that he's going to make, and I knew that that company is going to get acquired. But the technicals were saying that everything's declining, so likely the price will go down. But I knew that there is really, really high chances of that company being acquired, and that was a mining company, which is my sort of focus. And in that case, I did tell him, but he still went with his technicals. And in that case, of course, when the company got acquired, it got acquired at a premium, and the trade went against them. So when you combine technicals and fundamentals, it gives you that extra edge sometimes. But again, it's still completely fine to go by the charts only. And when I trade gold, for example, now I'm an investor as well. Trading is more like my side hustle. But with gold, of course, we know that fundamentally we are living in an era of fiat money printing, so the price of goods that cannot be printed over the long term will go up. So that's a nice fundamental. We know that now we're moving from a geopolitical perspective, from deglobalization or from globalization to deglobalization, meaning that countries get segregated into like little lumps, and we have the BRICS formation forming, etc. So in these situations where the world is not as stable as we used to, gold does really, really well. So that's a nice fundamental component: inflation, deglobalization. And then the chart looks really good. You can look at the historical charts, that sort of helps as well. And we had that peak in 2011, and in 2015 we got the low, and then we had that lovely cup and handle formation forming. So I hope you can see how I'm building my confidence in that trade. And that's would be more, of course, position trading, or but you can also do swing trades, or if you're interested, you can do day trading. But I believe it's quite difficult because, well, it's a job, first of all, but also with day trading, the charts on smaller time frames, they are never they never have as much weight as, let's say, charts on the longer time frame. So the same cup and handle formation would not have as much probability of going into the direction where you want it to go. So in the case of cup and handle going up, uh, where if you're looking at the very long, when it takes years for the pattern to form, then it sort of tells you that the probabilities are really, really high. Another one would be silver. You have this huge cup and handle from 1980. You had that peak in 1980, and now we're still nowhere close to $50 per ounce as we used to be back then. So those are sort of the basic things. The other thing I wanted to talk about would be ratios. I also like to connect ratios into my approach. So when of course, it's more related to fundamental as well, but ratios sort of can give you a perspective that you cannot really get by just looking at a normal chart. When you compare your stock of interest, your commodity of interest, whatever it may be, to something else, that could also tell you the probabilities as well. It can sort of strengthen your thesis or your trade, but that's also more towards long-term trading, so position trading, maybe swing trading as well. Then the other component would be stop losses. So with stop losses, it's, of course, some people don't use them. I don't always use them as well, but if you do use them, you need to understand, with experience you get that you sort of smell fear, and you can understand if you should loosen it a bit, because there are professional, these firms that specialize on all of these, so they can sometimes make the price dip a little bit lower so that all these normal people get wiped out, and then they can make money on that. And you need to understand that as well. Of course, you look at the volume and you look at all these indicators. RSI helps as well, but mainly with ratios, it's sort of another perspective in your chess box when you're analyzing your potential trade. And then if yeah, so pure trading is okay. That's sort of my approach. And then if you're still new to all of this, you can of course start trading with a fake account. I've never done it, so I don't know how it works psychologically, because I've heard many stories where people do quite well on a fake account, but when it comes to their own money, again, the emotion kicks in and they start to make bad decisions. But that's also something that you can do. But yeah, those are sort of the main things. And with practice, with that in mind, if you just remember that number one, discipline, and discipline, you really have to be disciplined. Number two, you have to have correct position size. And if you cannot put more than 2.5% of your trading portfolio, even if when you're starting out, you panic and you do something wrong, it's only 2.5%. And discipline comes to that as well. So those are the two main things. And then you would just need to learn the patterns. You would need to, which is quite easy, you can do that in a few weeks, really get to understand them. You can just look at cup and handle, head and shoulders, wedges, formations, whatever. You can look at candles if it's more short term, but even long term, you can see like the shooting star. The other thing, guys, to remember, trading charts are people psychology. So when you have spike and when you have the little what I call it, oh my god, I forgot. But anyways, you know what I mean. Um, if that happens, what does that actually mean? Well, that means that the price went up, and then once the price reached that point, people start selling. So psychologically, you should understand that people who were sort of involved in that market, they did not accept that price. They thought that it was too high, therefore it spiked, went down, and you had the, let's say, shooting star formation or a hammer. So inverse hammer. So it's also important to bring that into mind when trading, that yes, we're looking at charts, but really it's human psychology. In the same way, let's say you have a price going and then you're forming a little cup. Well, that means that the price sort of went down and then it stabilized at that level, and likely it's gonna at least go up. So you can set, if there's a certain trend line that you can find, you can trade on that as well. And once you are able to master the charts, you just need to determine if you want to be like me, where you like to include fundamentals as well, or if you want to go purely by the charts. Both are completely fine. There are people who are successful by using both approaches. So that's just for you to decide subjectively. In my case, I like to have that I believe that I have a little edge by also usually trading things that I understand at least a little bit from the fundamental perspective. So I understand what's going on in the market. I understand what's high, what's low. Because if you're trading purely on charts, you may not know the little intricacy and dynamics inside of that market. And that could cause you to make not really mistakes, but that could make the trade go against you. But again, if you are disciplined, and even if you go based by the charts only, you will still make money over the long term, because if you follow the trades, if you follow the patterns, you will be right more than you will be wrong. And in the long term, you will always make money. But that's easier said than done for most people, because that emotion kicks in. And the famous Warren Buffett, that you should buy when there's blood on the street. So this contrarian nature is really important as well, to be able to be alone, to be able to go against the odds, and to accept losses, because they're going to happen absolutely. They're going to happen all the time. And if you guys believe it, if you watch this video and you believe, well, is that it? That's actually it. So if you just follow these rules, and then if you get competent with the charts, you determine which way you want to go. That's really everything you would need to know. At least at this stage, you will have all the tools necessary to master it. If you're interested, guys, I have a free how to get started PDF. It's not fully related to trading, but even for traders, I think it's going to be really nice to go through it and understand different things, because trading is good, but I still believe it's not good to be one-sided. So it's still important to understand the fundamentals of economics, to understand a little bit of investing, etc. So it's completely free. I put a lot of effort into creating that PDF, so please have a look if you are interested. If you have any questions, please feel free to comment in the comments below. I will do my very best to answer everything. Thank you very much for watching. I'll see you soon.